Good morning and welcome to the Monday Market Update. I'm Nash Paradise. Joined with me here is Andrew Cady, back from your week off. We missed you last week, Andrew. Everything I talked about went out the window, except I was right. And I said, hey, be careful about Friday. Friday could be a rough day with jobs report. And, I can take my victory lap here and, be right every once in a while. So I definitely wanted to let you know that I was right.
Of course. I mean, it's honestly, Nash, I'll give you the win, okay? I'll give you the win. But it's not hard to predict that the BLS is going to screw up.
This is also true, but not everyone knows that. So just because it's an easy prediction doesn't mean it wasn't a good prediction. And, markets kind of all over the place. But let's recap what things looked like last week. The tail of the tape is interesting here. It looks like we started high, came down low, had a lot of volatility. Looking at the weekly chart in front of me, oh boy, a lot of huge drops and then really quick rebounds all last week. Kind of a roller coaster and not a safe kind. You would definitely get whiplash on this stuff from last week.
Yeah.
Any other feedback? I mean, it's funny how smooth that line looks, but it doesn't take into account what actually happened last week. That's just where we finished.
Correct. Yeah, that line is one tick per day. If that thing actually showed what happened intraday, it would be a very, very different looking chart.
Yeah, so all that said, we moved in the right direction, and we'll take moving in the right direction, starting off at 664, getting closer to 7 than 6. We were headed the wrong way, and, I love that we got to where we were going. Under 6.5 feels like win right now. So we'll take that on last week. Let's talk a little bit about the data last week. What was the econ highlights? We had some important stuff, on the first with ADP. Retail sales didn't really move the needle. ISM did a little bit, but like I said, it was a good Friday for, well, no one. I mean, Jesus, that's Good Friday, but even then, not really that good. Got to have long-term planning here. This, like any other Good Friday, it looks bad at first, but then there's light at the end of the tunnel. Those non-farm payrolls smoked at 178,000, unemployment rate dropping. But what does that really look like? What really happened with, the BLS data? Is there a reason that we're not getting the kind of, we had a good reaction Friday, but no one seems to care anymore. Why is that?
I think if you actually look into the report, 73,000, I believe it was, job creations was healthcare, which isn't a sign of a booming economy. That's, healthcare is going to be growing no matter what because Americans are sicker than we've ever been. So I think investors kind of took it a little bit with a grain of salt, and we had ironically a January increase, so it was a revision up, or was it February? I don't have I think it was January up, and then February was revised further down.
Yeah, February dropped from negative 92,000 to negative 133,000. That was a really strong revision.
It was this really strong revision. So I think it honestly, on face value, it hit the market, and this was part of the roller coaster last week. It hit the market face value extremely hard. But within a few hours, investors started to actually read the report and say, wait, a lot of job gains, but 50% of these are going to be in a sector that doesn't mean we're in a booming economy. And we had, a big negative revision and a positive revision. So face value of it was ugly, and then it kind of became a mixed bag of goods.
Yeah, we fell off a cliff, bounced back up, and then settled, getting a little worse. Like I said, Friday was not a good day. Hopefully, you got your stuff locked in on Thursday. And that's the best way, I think, to sum up last week is mixed bag, punched you in the face at first. And then from there, it's not quite as bad as it looks. But let's talk about what we got going on this week. This week is heavy and it's big. You probably can't see this on your screen. I can't see it on this screen. I'm going to look at this screen here, talk about what we got going on. Getting into the week, pretty slow with ISM already hitting today, very close to estimates. No one's really going to care a whole lot about that. But once we get to Thursday, this is when things start to light up. PCE, core and headline, jobless claims, continued claims, GDP. Friday, man, it's all our inflation data. We've got the March month over month core CPI headline. That's big news and some wild forecasts. Tell us what we're looking at here.
I think the one thing we are missing off of here that could be market moving as well is the FOMC minutes are going to be released at 2 p.m. Eastern on Wednesday.
Yeah.
And that is going to give us insight into Fed commentary about the conflict in Iran and what their real thoughts are. So I do think the FOMC minutes could be very interesting, but we probably won't see much issue probably with the PCE report. Any inflation drag into the personal consumption expenditures would be more into the April report rather than the March report. So initial jobless claims, definitely going to be something we have to keep an eye on. GDP measurements, something that could move markets. We're looking at 0.7% is what the estimate is. Initial jobless claims should be around 200,000. If we would miss on those, we could really set up for a Friday double whammy. Friday is going to be the big one though, because the estimations on what we're looking at for month over month rise in headline CPI is 0.9% in a month. 0.3% previous month, 0.9 is what the estimation is, and we could beat that. There's a lot of indications that say we could actually come in worse than that. And when you strip out food and energy, we're only looking at rising 0.3%. And to me, that's the one that we could actually miss. And I think that could be the dangerous one. We're only looking at a 0.3% rise on CPI because we're stripping out the energy cost. However, oil rising the way it has doesn't just bleed into energy costs. It bleeds into shipping costs. It bleeds into a lot of things that will end up in the CPI, maybe not this month, but next month. And so I do think Friday, buckle your seatbelts. It could be a very, very volatile day.
Yeah, 100%. I think a lot of people focus on energy prices and they look at, the price of gasoline and, my diesel fuel was $5.50 a gallon this morning. And Texas is generally on the lower side of cost when it comes to fuel. That impacts everything. It's every industry. That's anyone who needs vehicles to get to a job site. That's going to be construction costs, shipping, any kind of transportation, and any like at a certain point, if you buy goods and services, they're moved, they're trucked. If they have to get on an airplane, I was shopping for airline tickets this summer, and I was just absolutely floored at some of the prices right now. And I had an interesting conversation over the weekend with my mother-in-law, actually, who doesn't understand why we have all these oil reserves. Why did the price of gas go up so quickly when we still have the same oil that we paid the same price for, however long ago? And, we just have to remember that not everyone realizes the pricing on all things. This is all future casting. Right. Everything that we're looking at, like this is all planning and prepping for where's the price going to be in 6, 9, 12 months, which is interesting because, it doesn't seem rational that we have plenty of oil access and our prices shot up that much. It's going to cause some overreactions on Friday when we're looking at headline CPI shooting up 0.6% on month over month. And you're going to see the headlines that, hey, March inflation went from 2.4% to 3.3%. If the estimates are right, that's going to be a pretty big market mover. It does leave us a lot of room to miss on the low side, but with food and energy stripped out there, we're only factoring 0.3% for everything else. That's going to be interesting. I'm also looking at some overreactions on Thursday. Q4 GDP previous was 4.4%. Now we're forecasting 0.7%. That's a huge slowdown in the overall economy. And I feel like we could see some things move pretty heavy if, the combination of core PCE and GDP both come in off the mark on Thursday. End of this week is going to be dicey. And like you said, backing up even to Wednesday, the FOMC minutes, seeing what the Fed has to say about things, it could be a wild week.
And we also have a 10-year Treasury auction at 1 p.m. right ahead of the FOMC minutes at 2 p.m. So we could have this could be set up for a lot of wins. We could come in underestimations, okay, guys, but the probability of having 3 days back to back where we could be in trouble 3 days back to back could set us up for a really, really, really interesting end of week.
Could win though too. So hey,
could be a win. Be careful gambling. I'm not a gambler.
Speaking of gambling, let's take a look at where we are here on gambling on the Fed funds rate. I feel like the odds have shifted a little bit more in our favor. We've moved further and further away from, bumping up here to that next tier threshold. But from 2 cuts for sure earlier this year to no cuts for sure on the current projections this year, that's a pretty steady shift. But we have moved back into, long-term, relief on the Fed funds rate. Anything else sticking out at you?
No, but keep in mind, this is investor gut. This is investor sentiment or sentiment. And this could shift back to 3 rate cuts this year if something changes. So like right now, this is how investors feel. And I would tend to agree with them. I think the inflation will become our next battle because this conflict has lasted long enough that it's actually going to bleed into future reports. And this is going to be a bit of a sticky thing once again. So I think we're going to be in for it for a little bit, boys and girls.
Yeah, no big long-term projections on rate drops. This is nice in that without having anything closer on the line, we don't have to play that game of, will the Fed cut? Will we see that? That just gets obnoxious after a while. It's like, no one knows, but, analysts say X. And then next thing you know, we've gone from 60% to 40%. And, you don't want to be surprised by a Fed move. That's not great for the markets right now. So having all these in the upper 90s on certainty of not moving, not altogether a bad thing as we try to get some stability back in the Treasury markets.
Yeah, and Jerome Powell is just choreographing nothing. Like he had an interview last week where he said based on the data, we could have to increase interest rates or we could have to decrease interest rates. And I'm like, thanks.
Brilliant nothing burger right there.
Thanks, dude. You helped nothing.
Yep. All right, let's keep it going here. Hey, we finally get a little bit of relief. We've settled down. It feels like winning. It may not be, but it's funny is we're seeing huge uptick in applications right now. We're seeing spring buyers come out of the woodwork. And, I know in my neck of the woods, things are still heating up like they would as if rates were under 6%. You're not seeing anyone jumping into refinancing, but, this mid sixes, I guess, because we were here for so long, before, it's not really, people don't like to hear, oh yeah, you're at a 6.625. Like, okay, well, that stinks, 6 1/8 last week, but I'm not getting the same negativity that we had as we started blowing through these 6% rates that first time coming out of 2022 and 23. What are you seeing over your side? Does it feel like things have leveled off and getting some stability, or is it still a little tricky in the Florida market?
Florida market's still very tricky. For me, we saw the massive pickup when we saw interest rates tick at the 6%. Slowed down when we crossed 6.25 and really hasn't picked up steam again. Applications for January versus the month of March were down about 60%.
Yeah, I think that has a lot to do with, average price points. You're in a part of Florida where you're going to have a lot of big money and, 0.5% on $1 million home, $1.5, $3 million. Like that's going to move the needle for some people's decision making. Whereas, all the contracts I've got in the last week, they probably average $400K. And, that used to be a big home here in Texas. Now it's a starter home or a move up home. But it's still 0.5% on a $300,000 mortgage doesn't move things the same way as it does on $1 million loan. So I think that checks out depending on the different areas.
Yeah, it does. But you know what? we're still rocking out. Still going to have a really big month and starting to stack it up for June already. So everything's going well.
Love it. Things can be going good even when they've been going a little rough. There's always winners in these markets, and hey, we'll head that direction. With the crazy volatility that we have going on this week in the econ data, how would you close us out? What kind of call to action would you have for everyone out there trying to do business in the real estate world?
Have open conversations with your referral partners and your clients you're actively shopping with that this week could be a very interesting week. Be seen as the expert, be seen as the advisor, and then personally buckle your seatbelt because we could be in for a bumpy ride. Ladies and gentlemen, please keep your arms and legs inside the ride at all times. That's pretty much where we're at this week.
Yeah, and I think you got to be careful when you go through that and you try to advise. The first thing people want to know is, okay, bumpy good or bumpy bad? Are we thinking it's going to be volatile in our face? Like, everyone wants to know volatile in which direction. And right now we're on a seesaw. It's volatile either way. And It could be volatile both ways at the same time for the same information on the same day. Like, we could wind up having a week that looks totally flat, even though intraday trading has been all over the place. So it's a good opportunity to be the expert, be that advisor who lets people know what to expect. But I would call this a highly volatile week. And, whether that ends up being better at the end of the week, there's a good chance that works in our favor. There's a lot of stuff here where we can come in under estimates and look a little bit better because of these really big forecasts. But we could also hit forecasts and the market could react terribly, or we could get a tweet and change everything on Tuesday. The news can trump all econ data every single day. And the, proclivity for that, given the current conflict, is very, very high. So like I said, buckle your seatbelts, be the advisor, make those phone calls, and make sure to let people know that you are dialed in and tuned in on the market, so you can be the best advisor possible. And, we'll come back next week, recap what happened, and start getting a game plan, hopefully for some normalcy going forward, maybe, eventually. Love it, Andrew. Thanks very much. Y'all have a good one. We'll be back next Monday.
Take care, everybody.